Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. This is going to be our daily cryptocurrency market update, and we're really going to be diving into and kicking things off with the Fed minutes that was released yesterday. And this is pretty big news. We know that the Fed are the mass manipulator or the market manipulator because they ultimately control the supply of money and the sort of weight, the interest rate that money holds. And this is the game of investing, ladies and gentlemen. It's basically about trying to follow the flow of capital, follow the flow of liquidity. So when the Fed up interest rates, essentially, and you guys will all be well aware of this now, that dictates how free flowing or perhaps not so free flowing money is. We know that markets and money supply, this is the M1 money supply in orange that I've just overlaid, are extremely correlated. We can pull in really any kind of an asset over Bitcoin and with the money supply, and you can see there's a huge correlation there. So this is really important, and I just want to switch to the 30-day Fed funds futures. We'll take all my rather messy draws off. We'll get rid of the moving average, and you can see just the correlation that is apparent here. You know, this is the money supply, and then this, of course, is the 30-day Fed fund future. So this is a derivative that essentially works out where the Fed fund rate is going to be. When it goes down, that means interest rates are going up. There's an inverse correlation. You can see they currently have interest rates priced at 4.2%. So there's been a little bit of a kickback. And the real correlation here that we're interested in is, what effect do these rate hikes have on markets? And you can see that markets across the board, this is Bitcoin that I've just overlaid. We're also going to overlay the S&P, are very much in sync with interest rate rises. Why is this? Well, what happens when you up interest rates is you essentially give this massive asset class, which is the debt market, a refinancing or a reallocation of capital, money, liquidity, a concept that we constantly talk about on this channel. And this is something that we really have to pay attention to, because ultimately, if the Fed go back to being very accommodating towards markets through low interest rates or zero interest rates, and actually start to stimulate again, then you have every reason to expect that markets are going to go up as the sort of devaluation of liquidity, money takes place. And when you look at a Bitcoin chart, you're looking at Bitcoin against the US dollar, Bitcoin against the Great British Pound, whatever it is. And this is why the Fed are really the mass manipulators of markets. And the news that we got yesterday was after a rather aggressive tightening in terms of interest rate rises, they are now looking to put their, I should say, to take their foot off the gas. So this, of course, is going to affect markets. With this as well, this is why we've seen dollar weakness. We're going to talk about the dollar in this video because I actually thought that the dollar would have been a little bit stronger than this. However, yesterday it got a real slap in the face, and this would have been sort of preempting the Fed minutes coming out, and essentially has, if they were going to get a 75 basis point rate hike in December, which is the next one that we've got coming up, then maybe the dollar would have had a little bit more reason to be strong. However, they got a 50, and they are, and certainly were, sort of telegraphing that they were going to be a lot more soft in regards to interest rate rises and sort of how they go on from here, and they really express their concerns for the economy generally. We've seen mass layoffs. We've done so much analysis on this channel where we've looked at the unemployment rate with the S&P. The unemployment rate is typically at a low right now, or is at a low point, and the S&P is still really at a relatively high point, even though we've seen that demand destruction. And in our opinion, for markets to continue to rally, we need to see unemployment continue to fall. And in this environment, that doesn't seem very likely. So the problem that I've got with rallies on, this is something that we've maintained really for Bitcoin since around about 44K, is that there's nothing there that's really going to sustain them. However, there will come a time where enough pain and enough correct sort of vision or hindsight or foresight, I should say, has been given to liquidity being taken out. Why is it that we see, and we're going to get into what was discussed yesterday in just a second, Why is it that with the, let's pull up the Fed funds rate, why is it that with this going up, of course this is going down, but this means that the Fed funds is going up, why is it that we saw market sell off in preempt of this? Bitcoin in blue, S&P rather confusingly in like an almost orange color, Bitcoin orange. Well, it's because essentially what happens again is liquidity gets taken from assets and has to go back into refinancing debt as everybody feels the burden. We're seeing this in companies, we're seeing this across the board. And essentially what fund managers are doing is trying to take their capital and protect it. So if they have it in the S&P or Bitcoin and they think that the futures market or the interest rates are going to rise, well, they know that there's going to be a burden on other asset classes in regards to their liquidity getting drained and having to go to service the debt market. You know, we've got this kind of, it's almost like a river that has streams running off it. And a lot of those streams get rediverted back into the mammoth market, the colossal market that is the debt market that has a hell of a lot more refinancing. So there's a few things I want to say on this. Even a 50% or 50 basis point rate hike is still, in my opinion, rather detrimental, certainly given where they are. And I have real concerns. Even if they slow down, it's not a stopping and it's not a pivot, ladies and gentlemen. So the pivot narrative, now there's more reason to back the pivot narrative now than there has been because the Fed are telegraphing it. But it's not a pivot. So a pivot is when they start to reduce interest rates, not when they're continuing to up them or even holding them where they are. And you can actually see, this is interest rates, remember, in green. When it goes down, it means interest rates are going up. That actually the bottom of our bear market for the Bitcoin, which is in blue, actually started when they started to reduce interest rate rises. So this is what I need to see to get confidently bullish on the markets again. I'm not that interested in catching potentially what is a falling knife. Now, I want to do a little bit of TA on Bitcoin before we dive into what was discussed in the Fed minutes, because for me, I really don't think, I think there's some positives and negatives, right? We had FTX contagion, we had FTX collapse, one of the largest exchanges, and the cryptocurrency market, certainly Bitcoin after this rally, and we did say it's very, very common that you do get a rally into a sell-off, and of course we broke this grind line that we were grinding along, is only today down 22% from this, okay? You'd expected a considerably greater, in my opinion, crash than this. Now, the question for me is that crash still coming? You guys know that yesterday, you know, we called this short squeeze very, very accurately. We said, look, too many people are short here. We're getting out of our shorts. We don't want any part in this. But are you just coming back for this perfect retest? So you had this grind line. You could say it was a symmetrical triangle, which is typically a trend continuation that you were grinding along. You're doing this sort of, I like to call it a golf ball. You're running out of momentum. You smash it. Very common that you come up for a retest before you see that further continuation down. However, Bitcoin, when it made this leg lower, this leg lower, this is the recent consolidation that we've had since the FTX contagion, was selling off at a time where, bring the old stock market back into play, the stock market was going up. Let's get it off the hourly, guys. It looks a hell of a mess. So the stock market, during the time when Bitcoin was going down, actually did the adverse thing. And the reason that it did this was because the dollar was coming down, which essentially, to me, shows a lack of demand in people putting money into dollars and being dollar strong and moving it elsewhere. And this is why, you know, if you have a set pool of liquidity, you know, some of it's going here, some of it's going here, some of it's going here. And then the big one is, of course, the debt markets. And what we've had with the rise of interest rates is this debt market has become larger and actually started to suck liquidity from all these other pools. Is essentially you now have, okay, well, we've had very harsh pricing involved. We're now having a little bit of that capital actually start to flow back into these markets. Rather messy draw there. But this is essentially what we have taking place. And this is, you know, there's a couple of questions I'm asking myself. The dollar has been particularly weak. I still believe in dollar dominance and this comes back, right? Let's get rid of the S&P. However, it could stay rather flat for a while before it decides to come back up. You guys know that I actually believe for the dollar, what we're going to see is a 2001, this sort of a style event take place. And when the dollar comes back, all markets will fall into line. It had a 9% sell-off before then, going on to put a new high. Today we have had, let's get rid of all these squiggly draws. You know, we're still well in the realms of a pullback that could lead to continuation. You know, and this is my thoughts. I don't think the bear market is over, so to speak. However, I do think the vast majority of people are going to be too bearish for too long. I think that, you know, we have lots and lots of talk of, just wait till 2024 when the halvening comes around. I studied, and if you guys go and watch my very early YouTube videos, before the last bull market even started, it's how we predicted this bull market was coming about. Because Bitcoin, thus far, has moved in a 4-year cycle theory that is essentially centered around the halving. The halving takes place, Bitcoin's supply gets cut in half. It allegedly causes a supply and demand readjustment, which means the Bitcoin price goes up. And of course, Bitcoin is the tide that rises and sinks all ships. And markets go up, or altcoins go up with it. I actually don't think that, I think that's going to be in play. There's going to be an element of that, and we're likely going to appreciate in price. But I think really what's driving the market more so than anything is your interest rates. And I think that if we see, again, let's bring Bitcoin into the equation. And let's look at the 2000 and, you know, if we see some sort of a scenario like we saw back in the bear market of 2018, interest rates start to go up. So if we see something like this and then they go up, well, that's when we get on board, because that we understand that by them lowering, money doesn't disappear; it has to go somewhere. The interest rate, the sort of debt bears, then we know that that liquidity can flow elsewhere and likely is going to go into assets, certainly more appealing assets that are already at a big discount that people will look to capitalize on. So this is the game that we are playing, ladies and gentlemen, which is why it's very, very important to watch what the Fed and other governments around the world are doing. Remember, it's not just the Federal Reserve, but the Fed, the dollar is the world reserve currency, and it has a status on the back end of that. So the Fed officials see smaller rate hikes coming soon, minutes shows. The Federal Reserve officials expect to switch to smaller interest rates increases soon, according to minutes from November meeting released Wednesday. Some officials expressed concerns over the impact rate increase could have on financial stability and the economy. Markets have largely, so they're already showing concern. So I think they're going to show a little bit less concern than people would like, and I think they're going to still keep the foot on the gas for a little bit longer. Remember, why are they upping interest rates to fight inflation? Inflation is coming down, yes, but it's coming down due to deflation, which is typically another strain on the economy. We're in this kind of stagflationary environment already where we have high inflation and we have a sort of deflating economy. We have a negative economy, if you will. So markets have largely expected the Fed to dial down the intensity of its policy tightening, and the minutes helped confirm that. So what you're going to get potentially is, and we've been very against the pivot narrative, and we still are, and until we see it, you know, until we see definite confirmation of it, we stay very much out of the market. But essentially, this is going to fuel that. With a weak dollar, we see the likes of Microsoft, for example, get a very, very strong bid here. I mean, this is a significant candle for Microsoft at a low point. Still think there is the potential for it to roll over, but could it catch a bid in the mean term? And what is that going to mean for the crypto space? Are we looking at a potential rally at this kind of point that we're at? Well, for me, the first thing you've got to do is get over this support and resistance that we spoke about, which, of course, is here. Textbook, guys. You see this very low volatility. You spill out of it. You're now coming up to retest it. You start clearing this and getting back into the range. Is it out of the realms of possibility that you could potentially come back into before the FTX spill? Now, that's not my most probable scenario, but I do think it's a situation that could take place. And does that mean that the bear market is over? Well, we've just spent the first half of the video explaining what it means when we think the bear market is over, is when we think liquidity is going to be free flowing into this. There are some positive signs here in the sense that, you know, people expecting a 2-3 year long drawn out bear market, I think, are going to be largely wrong. And I think the only way that that happens is if the Fed keeps the rates up for that long, because things will break, things will, you know, it will be a real dire state, and the debt markets will just suck up all the liquidity from everything, including personal savings rates, which we see at an all-time low. So until we see a sort of lapsing of those very tight conditions, we don't really want to be investing in the crypto space just yet, or any real assets for that matter of fact. So reflecting statements that multiple officials have made over the past several weeks, the meeting summary pointed to smaller rate hikes coming. Markets widely expect rate-setting Fed Open Market Committee to step down to a 0.5% point increase in December. So it's coming next month, following 4 straight 75 basis point rate hikes. So I actually think this is pretty likely. A substantial majority of participants judge that a slowing in pace of increase would likely soon be appropriate. The minutes stated, the uncertainty, lags, and magnitudes associated with the effects of monetary policy actions on economy actively and inflation were among the reasons cited regarding why such a assessment was important. So you've also got to watch jobs as well. The Fed don't want jobs to sort of decrease. The main message of this is, for now, even though there is reason to expect now we're going to have this sort of readjustment, and people are going to take this news and look to reallocate capital accordingly. You know, if we're getting less of a rate high, that means more liquidity. That means potentially markets may go up in certain areas, or catch a bid as a result of this. We are potentially going to get less. We are potentially going to see, there is the reason to expect some sort of a rally here. Doesn't mean that it's going to happen. And I still want to be very, very confirm this, that one thing that people really aren't pricing, in my opinion, is risk. There is still a hell of a lot of risk on the table, ladies and gentlemen, that absolutely cannot and should not be ignored. Okay, so there's many, many catalysts. I was reading this from Jim Benanco. As of late Tuesday, Wall Street was still talking about the end of zero, something that shall not be named, and China reopening. Now we might have to reconsider. Hard lockdowns are coming. China daily, something that shall not be named, cases rise to 29,754, most during the demic. Where will this be in a week? So, you know, a lot of people sort of going, okay, there's good reason to be bullish broadly. One factor in all of this is what's going on with China, and the fact they've been locking down, and this has caused supply constraints, and that, you know, this is a big driver of inflation, and the fact that, okay, well, look, inflation is coming down and China's reopening, so this is happy days. This is all going to filter into the Fed's decision. Well, that may be a factor that is now no longer on the cards. And essentially, this is something else that I thought was very good from Wi-Fi Alpha. When the big boys want to buy Bitcoin again, they will smoke out the existing whales beforehand. This will not happen until the macro picture, so what we've been talking about, improves. Bitcoin is a classic liquidity measure. Absolutely. What have we been talking about, guys? It does not drive traditional asset classes, but it is a tell. So essentially talking about it being a higher beta, you know, it's a metric to weigh up capital and where it's flowing. And if capital's flowing into Bitcoin, then it's likely going to be flowing into more stable and more established markets like the S&P, and so on and so forth. So it is Thanksgiving, massive. I'm not American, as I'm sure many of you can tell. However, I do want to say a massive happy Thanksgiving to everybody. I hope you guys take this holiday to enjoy yourselves, relax if nothing else. But this is the game that we're playing, guys, and on this channel, we're going to keep you up to date. So for me, let's get over here first if we want to expect a higher rally. If not, you know, maybe you get some sort of a scenario like this, or we get one where we just, you know, plummet through the floor, and ultimately we find out that there's a lot more contagion. The FTX situation is a lot worse than we first thought. I'm still relatively shocked that, given everything that happened, let's bring up the total coin market cap. Is this the total? Yes. So we actually only, in terms of a market cap, Okay, so 30% drop is significant, but we're only 23% down. So potentially we haven't seen full contagion from this yet. However, you know, things seem to be relatively stabilizing. Again, this is absolutely not me calling for a bull market here, guys. This is just me saying that things may catch a bid, certainly if the dollar stays weak, but we still ultimately envision further pain coming down the road, and we'll not be looking to allocate capital until we have a lot more concrete reasons to do so. So we're still not investing, but we are watching the situation very closely as it unfolds, and this, of course, is huge news and is definitely, as we've shown you in this video, going to affect markets. All I've got for you in this video, guys, you enjoyed the content, like, as always appreciate it, so it's a comment, and I look forward to seeing each and every one of you in the next YouTube video. Thanks a lot for watching, ladies and gents.